Thank you for attending this session today in our webinar series at Cash Flow Champs. It is our intention to provide you with good content on a weekly basis, develop good relationships, and also be a resource for you in the multifamily space. Today, we'll be covering the topic, understanding key investment metrics in multifamily syndication. I am Paul Sr., and one of the managing partners at Cash Flow Champs. I'm married. I live just outside Washington, D.C. with my wife and 3 children in Prince George's County. And to get a little bit more information on us, you can always go to our website. And if you hover over about us, you can come to our team and you will see information here about our team. You can get more information on myself as well and all of our team members that are here. Another thing you can do while you're here, you can also click on schedule a call with us. And you can go on in here and just fill this information out. And one of our partners will definitely reach back out to you and answer any questions that you may have. We also have other opportunities for you and resources for you here at Cash Flow Champs. One is a free underwriting session that we hold every Saturday with one of our managing partners, Charles Seaman. So you can just go to our website there as well. And if you go to cashflowchamps.com/underwriting, then you will be able to see it there. And you can join there, just sign up there. We also have an aristocrat coaching program. We have a new program we kicked off, and we have students who are going through that currently right now, and that would be a good thing for you to do. Also, we have a free summit that we do every year, and this one coming up is going to be in November 17th through the 19th, 2023. You can feel free to sign up at cfcsummit.com. Last year's recording is also still there, and you can feel free to get that information there as well. If you go to cfcsummit.com, you can click on the 2022 recording, and you can definitely purchase a recording there. It's a very valuable resource. We had the best speakers in the country, to the likes of Dan Hanford, Trevor McGregor, Jake and Gino, Rod Cleef, and just guys who's been around for a long time and can provide a wealth of information for you. So you may want to take advantage of that also. So yeah, let's all the housekeeping duties there. Let's jump into the topic for today, which is understanding key investment metrics for multifamily syndication. So in this webinar, we'll cover the different types of investment metrics for multifamily syndication. And we have a few here on the screen: capitalization rate. We have the cash and cash return, equity multiple, debt service coverage ratio, DSCR. We have the IRR, and also the average annual return. We'll see if we get through all of these here today, but certainly we want to highlight each and every one if we can do that. If you have any questions as we go through, please put those in the chat, and we will get to those at the end of the presentation. So you can just put it in the Q&A to the bottom. We want to keep the attorneys happy, so let's read this disclaimer. I am not an attorney, financial advisor, tax advisor, or an accountant. The purpose of this webinar is for information purposes only, so you do want to seek advice from the appropriate personnel. Before I get started, just to take a quick poll of the audience here today, just if you could do me this favor, if you have been investing in multifamily space for 2 years or less, can you put a 1 in the chat? And if you've been investing in the multifamily space for 2 years or more, put a 2 in the chat for me. So I get a poll of the audience. Got a 1, 1. 1, 2. I'll take a second here to see what we have. Okay, all right. So it looks like we have a nice mix here, which is great. So there are key investment metrics that are indicators to whether or not a given multifamily investment opportunity is worthy of your investment dollars. Real estate in general and multifamily properties in particular has been a solid investment option for many investors. Real estate investing has produced more millionaires in the US than any other asset class. But unfortunately, many real estate investors have also suffered big financial losses in the real estate for a variety of reasons. It therefore begs the question, how can one evaluate a real estate investment opportunity and make a determination if it is a good or if it is a bad investment? So first, there are no guarantees for a positive return on investment in real estate syndication. Real estate investment, like most other investment, has a measure of risk associated with it. There is a built-in or inherent risk with any real estate investment. However, there are some investment metrics that can serve as a guide to selecting the right property as an investment vehicle. So most of the key metrics of multifamily investment can be determined through the process of underwriting. So having a good handle on underwriting is important. So let's just take a minute to go over the concept of underwriting. So what is underwriting? Right? Underwriting is the gathering of financial data about a property. 1. 2, it is also making assumptions on the future projections or performance of the property. And it's also building a projection of income, expenses, and investment returns, also known as your pro forma, right? So ultimately with underwriting, you want to use it for assigning a valuation to a property. So talking about gathering of information, what are these financial data that you want to gather? Well, typically you will gather information on the T12, which is the financial statement that shows the trailing 12 months of operations for income and expenses. You'll also get the rent roll. You can get taxes on the property, and some brokerage firms will have you offering a memorandum, right? So those are some of the information you want to gather in terms of underwriting. You also want to make some assumptions, we say, of the future performance. So you may make assumption in terms of rent growth or the cap rate at exit. So the purpose of gathering this information is to put it into a financial information, is to gather, you want to gather all this information, put the financial information gathered into an Excel spreadsheet or underwriting model, and that will analyze the data and assign you a valuation. So why is it important? Why is underwriting important? Well, the key reason of underwriting is to determine a value or a price for the property based on targeted returns of the investors or the sponsors, right? So you use underwriting to create sensitivity analyses. With those sensitivity analyses, we can better evaluate possible upside or downside of an investment. We also use underwriting to help prevent you from making foolish or emotional decisions just based on the beauty of the property or just the appearance of the property, right? So underwriting forces you to look at the numbers, because a true real estate investor knows that the number, they know that the value rather of the asset always come down to the numbers, the price you pay for the property and the return you get. So there are a variety of multifamily investment metric, and we're looking at a few here. We are talking about the capitalization rate. We said before, the cash and cash return, equity multiple, the debt service coverage ratio, the internal rate of return, the average annual return. So let's delve into these just a little bit, and we'll start off with the capitalization rate. What is cap rate? Well, cap rate, for starters, the abbreviation for capitalization rate. The cap rate is the assets unlevered return. So it is an unlevered metric. And by unlevered, we mean there is no mortgage on the property, right? The rate of return on your investment. So the cap rate is the rate of return on your investment if you were to purchase that property for all cash. It's important to note that the cap rate does not take into consideration any mortgage. So the formula for the cap rate is the NOI, the property's NOI divided by the purchase price. And NOI is an acronym, stand for net operating income. The NOI is really the gross income of that property minus the operating expenses. And it is important to note that we're talking about operating expenses because with operating expenses, we're thinking of things like, the payroll, maybe contract services, repairs and maintenance, administrative fee, taxes and insurance for sure. So we're not including any type of capital expenditure, and neither are we including the debt service when we're talking about calculating your NOI. So the cap rate is a measure of risk and return on the investment. A low cap rate, say for example, a 2% cap or a 3% cap or 4% cap, that would mean that the asset is a lower risk and has higher valuation. A higher cap rate of say 8%, 9% and beyond, that reflects a lower price with higher risk and higher returns typically. So how is cap rate used? Well, one, you can use it to track the trends in the market, right? As buyers, we also use the cap rate to determine if we're getting a deal on a property that we're looking at. Brokers and sellers use cap rate as a sales tool to attract buyers to their properties. And also the cap rate is a metric that a buyer can use to compare the price of an asset in the market with other similar properties that has recently been sold. So let's look at an example here using the cap rate to compare price, right? Look at this example. A buyer is interested in purchasing an apartment building with 100 units, each unit earning $1,000 a month in rent. The property's annual operating expenses are $200,000. If the market cap is 7%, what would be a reasonable purchase price for the property? Well, first I want to go ahead and calculate the gross income of the property. And you do that by simply multiplying the number of units by the earnings you're getting per unit. So in this case, it's 100 times $1,000 per unit, which is $100,000 per month. And of course, we annualize that to get $1.2 million. So we saw the formula before where the net operating income is equal to the gross income minus the expenses. So here, your gross income is $1.2 million. The operating expenses is $200,000. So here, your net operating income or your NOI would be $1 million. So to get the property's valuation, you simply divide that $1 million by the cap rate of 0.07. So your valuation here on this property would be $14.285 million. So what this does, the cap rate helps you therefore. So if somebody was trying to sell you this property for $17 million, by using this cap rate in data here, you can determine right away that this property is overpriced property, right? But if you were getting this property off market at say $12 million, then you know right away it's something you need to jump on immediately because this is a good deal. So it helps you to make, decisions pretty quickly, and so that you can take advantage rather of opportunities that comes in the marketplace. To determine, also you can use a cap rate to determine if a refinance is possible. If you know your property's value based on the NOI and the cap rate of similar properties in the area, then you can determine the potential loan amount based on what the lender's LTV is. And another use of cap rate is that buyers use future estimated cap rate to model the projected returns of a property based on its purchase price. So that is all the process of underwriting, right? So let's look at the sources of cap rate. How do we determine cap rate? Where does that come from? Well, it is important to have accurate information about cap rates in your market area. Without accurate cap rate data, it is difficult to determine if a property you are considering to purchase is providing a competitive return. So some of the best sources of cap rate is commercial real estate brokers, right? They're there in the marketplace. They're working those markets every day, and they pretty much have their ears to the ground in terms of what's happening. They're seeing the transactions that are taking place in those marketplaces and see the trends that are forming. So getting your cap rate from your commercial real estate broker is a fairly reliable source right there. Also, you can get your cap rate from your commercial property appraisers, right? Another source of cap rate is CoStar. If you're subscribed to CoStar or have access to CoStar, then you can get your information there too. Some internet sources like realtyrates.com will also provide that as well. Of course, like I was making mention of the brokerage firms, like most brokerage firms, they have reports coming out probably every quarter. They're talking about the bigger brokerage houses like Marcus and Millichap, CBRE, maybe Cushman and Wakefield. Those guys have reports coming out on a quarterly basis, and in those reports, you can definitely get cap rates data as well. So let's talk about the different type of cap rates. Well, you have normally when people say cap rate, they're thinking, probably market cap, right? But there are also different type of cap rates as well. The market cap is definitely one of those cap rates. So it's a cap rate. The market cap is a cap rate you're getting at the property on a stabilized cash flow, right? So that's different from your operating cap rate. So any deal, the operating cap rate applies to deals where you'll implement a value add business plan. For example, if you have a 5% market cap on a property with a stabilized cash flow, you could decide to implement a value add business plan and grow that property's operating cap rate to say 7%, right? If you're successful, then that is substantial capital appreciation. In essence, you've built a stream of cash flow for a 7% cap, and you can sell those same cash flow at a 5% cap. So you can make lots of money that way using a value add process, like we just went over in that example. So the third cap rate is also a very common cap rate, which is your terminal cap rate. And terminal cap rate, aka your exit cap rate, that is determined from the market cap. So it is a projected cap rate at which you will sell the property or you will sell the investment. So people normally add 10 basis points per year to the market cap over the whole period to determine the exit cap rate. Today I would argue that, with the market conditions softening, operators may want to think about increasing, maybe from 10% to 15, 20% in terms of, the number of basis points added per year, because we're in a totally different market than we have seen over the past couple of years. One caution is that terminal cap rate is a very sensitive metric. So a small change in your terminal or exit cap rate can make a huge swing in your purchase price, right? So if you ever go into an underwriting model, you can definitely test that out there, and you want to make sure that you're very careful in terms of the terminal cap rate you're using. One important thing is that investors should not rely on any one metric to make a determination on acquiring an asset. The investor should consider many of these metrics working together, and so that they can see an overall picture in terms of the asset that they're looking on, so that they can make the best informed decision. Let's take a look at another metric. Let's think about the cash and cash return, another metric that is very common in our marketplace. What is the cash and cash return? Well, the cash and cash return calculates the cash income earned by the property to the cash invested into the property, right? So like cap rate, cash and cash return is expressed as a percentage. So the cash and cash return can be based on projections for any future year, but investors tend to look keenly on the expected cash flow for the first year of ownership, because if the cash flow looks good in year one, it will normally increase for successive years due to increase in rental income. So the cash and cash return is a levered metric. So it is a return that is determined after debt service, right? Cash and cash return is used by real estate investors to assess the potential investment opportunities. So how can you calculate a cash and cash return? Let's see. We have an example here that we can look at. You purchase a property with a down payment of $20,000. In the first full year of operation, the property shows a net operating income of $14,000. Your monthly mortgage payment is $1,000. You have no other items that affect the cash flow for that year. What is your cash and cash return for year one? So the first thing you want to do is you want to figure out your cash flow. So the cash flow before taxes would be your NOI minus your debt service. So in this case, we know that NOI is $14,000, right? And your debt service in this case would be $1,000 annualized. So that would be $12,000. So your cash flow there would be $2,000. So you, by the formula, the cash and cash return then would be your $2,000 divided by your $20,000, which is the amount you invested. So in this case, you would have a cash and cash return of 10%. Another metric that we're going to go over today is your equity multiple. The equity multiple is defined as the total cash distribution received from an investment divided by the total equity invested. So this metric measures the total cash return on an asset over the entire hold period of that investment. So just for clarity, we can also, so as an example as well, if the total equity invested in a project is $1 million in this case, if all the cash distribution received from the project totaled $2 million, what would be the equity multiple? Well, this one is very straightforward, right? That would be 2.0. So, but what does an equity multiple of 2.0 means, right? So a lot of people, and probably some of you guys here, since a lot of you have a 1 in terms of the experience, you probably going to be going to a webinar where folks will be given these different metrics. Equity multiple is probably going to be one of them. And you'll see somebody say, I have an equity multiple of 1. I have an equity well, not 1, hopefully. Equity multiple of 1.8, maybe 2, 2.4. But what does those equity multiple mean? Well, first, an equity multiple less than 1 means that you'd be getting back less than you invested throughout the whole period. A 2.0 equity multiple means that the investment generates twice the amount of principal invested after taking the operating cash into account and also the final sales price. So it goes without saying that the higher the equity multiple, the more desirable the deal, with all other things being equal. This is an infamous internal rate of return. I think we're doing good on time here. Internal rate of return, IRR, average rate of return, AAR, right? Let's touch on the internal rate of return. This is probably the most common metric used by investors. The internal rate of return is the annual return, is the annual rate of growth that the investment is expected to generate, right? For Multifamily syndicators, most operators solve for an IRR of say 12 to 15% or better for their investors. A higher IRR typically means a higher return on investment. So the IRR takes both the timing of the cash flow and the magnitude of the cash flow into account, right? So the IRR is sensitive to the whole period. So if you were to run an IRR sensitivity analysis, you would notice that you tend to maximize the IRR in the early years of the whole period. And so if you're a limited partner or a passive investor, then what you want to do is get into syndication deal that distribute or give distributions maybe on a quarterly basis or maybe on a monthly basis, because the quicker you get your return back from those investments, then the better you'll have your IRR look. So the IRR is a discount rate metric. Yeah, it is a discount rate that makes the net present value, they call it NPV, of all the future cash flows equal to zero. Now, so when someone has like $100,000 to invest in a multifamily offering, which say a 15% IRR, that person is saying that I'm discounting the future cash flow of this deal by 15%. And what that really means is that you think that if you had this $100,000 in your hand, you could invest it for an average of 15% per year over the next 5 years. I'll show a glance of the formula that is used to calculate IRR. I mean, this is, to me, this makes my eyes cross. This is crazy. But, you know, this is, so don't even think of taking a series of cash flow and a cash investment and attempt to figure out the IRR manually, right? IRR must be figured out using a binary search, and there are more less painful way to do this, right? And you can definitely use it for using financial calculators. You can use it, or also Microsoft Excel is one way you do it, of course, through the process of underwriting as well, right? We're going to be winding down in a second here. No, this can sometimes get a little bit boring, but hopefully you're still there. Let's look at your average annual return. Another thing that you will see in most presentation in terms of a webinar. And your average annual return, or AAR, is a formula that's used to measure the performance of an investment over a period of time. So to calculate AAR, you simply want to take the annual cash on cash return for the year of the investment and average these. So this one is very simple. So in a case like this, the example I'm showing here on the screen, you can see year one, you make an initial investment of $100,000. In year one, you get a 5% cash and cash. Year two, same thing. 3 and 4, same thing. And year five, you get 125%, right? So simply the IRR would be you accumulate all those cash and cash, and you divide it by the whole period of 5 years. So it would be the 125 in year 5, the 5 in year 4, the 5 in year 3, 5 in year 2, 5 in year 1. That gives you 145 total, and you divide by the amount of years that you hold that of your whole period. And then in this particular case, you would be getting a 29% AAR, which would be a great AAR to get under any circumstance. So the most notable difference between the AAR and the IRR is that the IRR is a more sensitive metric when it comes to deal analyses. We're just about 30 minutes in here, so we'll just wrap it up with the DSCR. This is the debt service coverage ratio. The DSCR is a key metric of a company's ability to repay its loans and to take on new financing. So the formula for the DSCR is the annual NOI divided by the annual debt service. So DSCR greater than 1 means that your business has enough income to pay its debt. A DSCR of 1.25 means that your business makes 25% more income than it needs to cover its debt. So if you have a DSCR of 1, it means that the company is bringing in just enough income to cover its debt and there's no profit left over, right? So with DSCR is an important metric for lenders because it helps to determine the risk associated with financing that investment. Lenders typically like to see a minimum DSCR of 1.25. So if you are looking at an investment opportunity that's been presented to you, then that's something that you want to take a key note at. Make sure your DSCR is at least 1.25, where you know that deal you're investing in, it has enough income, can support the property itself. Again, I want to reemphasize that there's no one investment metric that has all the answers. So for this reason, we want to look at a variety of metrics, inputs, and projections, and performer when considering an investment opportunity. But it's very important that we get a good idea in terms of what these metrics are, so that we're not going in blindly in terms of investing into projects with our fingers crossed. Now, let me stop sharing my screen here. So, you know, you definitely want to make sure you get a good idea in terms of what these are. You may not know it all the way through. You don't need to know some of these things all the way through. But again, that's why I started with the process of underwriting. When you underwrite using some type of Excel spreadsheet, then most of these will be in there in terms of your underwriting, so that you can have it right there before you, after you put it in, you know, your information from your rent roll and your T12. So I'll take a peek here at the Q&A to see if we have any questions here, and we'll answer a few, and then we will leave it there. Right. See anything here? Prashant, do you see anything there? Okay.
No, Paul, I don't have any questions.
Okay, that's fine.
And you can ask everybody, you know, those, if there are any questions, please put it in the.
And they talked about you, Prashant. How did you get so handsome?
You know, I'm not on camera today.
But guys, okay, so that's fine. We're right about time anyway, right about 35 minutes in. We really appreciate you showing up here today. Cash Flow Champs continue to get good content out there, and we have a lot of resources. We make mention of those at the top of the webinar here today. Again, Charles Seaman, one of our managing partners, does have an underwriting session on Saturdays. You can feel free to go to our website, cashflowchamps.com/underwriting. And at 4 p.m. on Saturday Eastern time, he goes through a full underwriting of deals, where we go over the T12, the rent roll, the offer and memorandum, and you really get a good insight in terms of what we do in terms of underwriting our own deals. And you can also get a better understanding, even if you're a passive investor, in terms of what to kind of look for when you're looking at webinars and try to make investment decisions. Again,
there are a couple of questions. Sorry to cut you off.
Okay. Okay, let's scroll through here. So hi everyone, here's a handy glossary of many terms. Somebody's offering that. Dean said, how did you get so handsome? What do you consider a good AAR, average annual return? Typically, so the question is, what should be considered a good AAR value? Typically, it's right very close to the IRR. Most people want to go with the IRR of say 13 to maybe 15%. So your AAR normally a little bit higher. I would say probably anywhere from 14% and higher would be 14 to 17% would be a good range. I would think for an AAR, but certainly the higher you go, the better it would be for you. Say, is cap rate changing in present market for interest rate? Yeah, our cap rate is decompressing significantly right now, right? We in markets where cap rate last year was 3.5%. Those markets are decompressing and to even 4.5, almost 5 at this point. So, but right across the country, that's a universal movement right now, where cap rate is definitely decompressing. Somebody say wondering about cap rate, same thing. So listen, guys, the market is softening, and with the market softening, interest rate, cap rate tend to follow interest rate, right? So interest rate has been rising for the past couple of months for sure. So that is helping with the decompression of the cap rate. And what that's going to provide and is already providing is opportunity for buyers, right? For a long time, cap rate were so compressed, and with that, sellers were in the driver's seat. With lower cap rate, like we make mention of before, that means you get a higher valuation on your property. So when these cap rate has been compressed for so long, so for so many years, sellers were just calling the shots, and they could pretty much get whatever they want or wish for their property because the cap rate were so compressed, giving a higher valuation on the property. Now that is changing, right? It's decompressing, they're expanding, and so it's an opportunity for buyers to get in there and pick up properties at really discounted price, or maybe normalized price. That's what it should be in the first place, right? So this is a great time if you're an investor to get into some good deals and buy in while the property prices are dropping, and so that when you have the next rise and compression of cap rate, then you can get serious money in terms of returns on your investment. So Elisa, hopefully that helps. Is there a discrepancy between market and local deal cap rates? Not exactly sure what you mean by local deal cap rates, but the market cap rate, is the cap rate for that particular property, right? Based on the NOI that the property is producing right there. So, not sure what the local deal cap rate you're talking about, but certainly in general, your market cap rate overall, they are decompressing too. So you should be getting better deals out there. Hope you will be sending out the recording. Thank you. Also appreciate screenshot. Yeah. So yeah, we will be sending out these recording so that folks can listen to these things again. And if you have any questions, also reach out to our group. It's 11:40 now. I think we'll now we will get it, and someone from the investor relations team, probably myself, will be in touch with you. Would love for the opportunity to see how we could work together, but more importantly, educate yourself. We think an educated investor is the best investor, so certainly you want to do that. We will have quite a few multifamily offerings coming up this year, and so would hope for you to partake of that, where we can build wealth together. Again, Paul Sr. here signing off. Thank you so much for the opportunity, and have a great day.